A line in the sand. India's bold move. India has launched a significant military operation against Pakistan. Codenamed Operation Sindoor, the strike targeted alleged terror camps operating within Pakistan-occupied Kashmir. This action comes on the heels of a horrific terrorist attack that claimed the lives of 26 Hindu tourists in Kashmir. India claims the strikes were precise and targeted solely terrorist infrastructure. However, the situation remains extremely tense, with Pakistan vowing a forceful response. This is not just another border skirmish. This event marks a serious escalation between two nuclear-armed nations. The world is watching with bated breath. The immediate impact on the markets has been undeniably negative. The GIFT Nifty index tumbled, reflecting the fear and uncertainty gripping investors. Airlines, already sensitive to geopolitical turmoil, have cancelled flights. The situation is fluid, and the coming days will be critical. Market shockwaves navigating the fallout. The roots of this conflict run deep. India and Pakistan have a long and troubled history. Disputes over Kashmir have led to wars and countless smaller clashes. Terrorism emanating from Pakistan has been a constant thorn in India's side. The recent attack on Indian tourists proved to be a tipping point. India's military action, while shocking, is not entirely surprising given the context. The market reaction has been swift. The Nifty 50, India's benchmark stock index, is expected to see significant volatility in the short term. Investors are understandably nervous. Uncertainty breeds fear, and fear can lead to panic selling. This is precisely the time when cooler heads must prevail. While a market correction is possible, a full-blown crash is unlikely unless the conflict spirals out of control. Sectors in focus, where the action is. Not all sectors are created equal in times of geopolitical turmoil. Some sectors, like defense, tend to benefit from heightened tensions. Others, like airlines and tourism, are likely to suffer. Understanding these dynamics is key to navigating the current market turbulence. Defense stocks are likely to see increased investor interest. India's military spending is expected to rise, benefiting domestic defense companies. Pharmaceutical companies, often seen as a safe haven during uncertainty, may also outperform. Conversely, sectors reliant on global trade and consumer sentiment, like automobiles and consumer durables, could face headwinds. Section 4. Investor Playbook. Short-term and long-term strategies. So, what's an investor to do? First and foremost, don't panic. Knee-jerk reactions are rarely profitable. Avoid dumping your entire portfolio based on fear. Remember, market downturns can present buying opportunities for savvy investors. Now is the time to focus on quality stocks with strong fundamentals. In the short term, consider defensive positions. Gold ETFs, known for their safe haven appeal, can provide a hedge against market volatility. Pharmaceutical and consumer staples companies, with their relatively stable earnings, can offer some downside protection. Long-term investors should adopt a wait-and-see approach. Monitor the situation closely, but avoid making hasty decisions based on short-term news flow. Section 5. Looking ahead. Charting a course through uncertainty. The coming days and weeks will be crucial in determining the trajectory of this conflict and its impact on the markets. Will cooler heads prevail, or will we witness further escalation? The world is holding its breath. One thing is certain: volatility will persist. Investors would be wise to stay informed, stay disciplined, and avoid emotional decision-making. This too shall pass. Markets have weathered geopolitical storms before, and they will do so again. Those who remain calm and focus on the fundamentals are best positioned to emerge stronger. Remember, fortune favors the bold, but it also favors the prepared.